Hello and welcome to the Konvergent video series for the week of May 18th. Or as I like to consider, this is my third self-haircut during quarantine time, so it makes sense since it's been about 2 months during this. But hope you all are doing well, staying safe, staying healthy. Just one bit of housekeeping. The entire Konvergent team is now back at the office full-time and here to serve you, although I really am excited for what we were able to accomplish by being flexible and working from home for most of the last couple months, but I'm also excited to have the team back together again to serve you. So with that, let's get into the data for the week. So last week, the S&P 500 was down just a little bit over 2% for the week, but it didn't get there in a straight line. So early in the week, the market was down pretty severely, and then we saw the market recover in a big way near the end of the week, right as some of the worst economic data in history was released. So let's jump into the economic data. First, on Thursday, the new claims for unemployment were close to 3 million. And so we're still tracking well over 30 million of new claims for unemployment over the last 7 weeks. And then continuing claims were almost 23 million, which to me is a more important number because it's showing the people who are staying on unemployment for a long period of time. And that's a pretty severe number, which makes sense given the rest of the economic data that was released on Friday. So first, retail sales were released and they were down 16% month over month. One of the worst prints in history, and industrial production was down over 11% month over month. So both, you can see from the charts just the severe nature of the drops that we are seeing. And then the last one that will pop up here is consumer sentiment. So this is what people are thinking about in a survey format of their feelings for the future of how they'll spend money. Also a really severe drop, but interestingly, not as much as expected. And so, while everyone is, still concerned, generally spending hasn't gone down quite as much as people were expecting, or they're not thinking they're going to drop their spending as much as people were thinking. So what does that mean? Where are we going from here? And the reality is, I feel like a broken record sometimes because all these videos over the last 6 to 8 weeks, we don't really know, and so we still expect a lot of volatility to come in the coming weeks as more data continues to be released. We expect the economic data to continue to deteriorate, but some of the news on economies opening up is providing some hope and optimism with that. So we don't want to miss the forest for the trees. We don't want to be so focused on just some of the data and not all of it. But this chart I think is pretty interesting because this is a look back over the last 70 years or so between bull markets and bear markets. And what you'll see is that the average bear market typically lasts about 1.3 years, while the average bull market lasts about 6.6 years. And so, we want to make sure we're not missing out on the upside over the long run in these bull markets. But at the same time, we're only 2 months into this current bear market. And as I mentioned, the average bear market lasts over 1 year, about 1.3 years. And so again, we want to be cautious. We still feel right now that there's more risk to the downside than opportunity to the upside. But as soon as the data changes and we start to see more optimism for the economic data, we definitely are going to change our picture on that as well. But right now, we're still planning to remain cautious. But with that, I also want to use this time with you each week to talk about some other opportunities and ideas that aren't just about the market and the economy. So today I'm going to talk about 2 things. First being Roth conversions. So Roth conversions, the ideal time to be considering Roth conversions is when the market is down. And the reason for that is if we believe the markets will recover, which we do, the best place for that recovery to happen is in a tax-free bucket inside of your Roth IRA. The downside to Roth conversions is you've got to pay tax up front to complete that process. So it's not right for everybody, but it's something that we at least should be considering. The second one is required minimum distributions and the relief that has come up in the stimulus packages to allow you to waive your required distribution for this year. And so again, it's another tax planning opportunity that we're looking at, just like with Roth conversions, behind the scenes for all of our clients as to whether it makes sense. And again, it may not make sense, but it could provide some tax savings this year. So it's something that you should consider. So I'm asked all the time by successful families and business owners, are we making critical mistakes or missing out on opportunities? And this process that we take our clients through, the stress testing process, allows us to make sure that they're still going to be on track for their goals no matter what happens, and evaluate all of these different opportunities like we just discussed. So if you would like to take advantage of a complimentary diagnostic to see if you have some opportunities for some ideas like we're talking Roth conversions and other things like that, we'd love to schedule some time with you. So please feel free to reach out and get that on our calendar. We'd love to chat with you about that. So with that, have a wonderful week, and we'll look forward to talking with you soon.